find your way back home.
Hello everyone, welcome back to the Eat Sleep Profit YouTube channel. Now I know I haven't been uploading videos recently. It just had a lot of stuff going on, different businesses, mom's illness. But outside of that, today, especially I want to actually get more videos out and just more tutorials, how-tos and everything else. A lot of people have been liking the videos that I upload, and I've kind of been on this hiatus, so I'm basically back now. So today what I want to go over is the PDT rule and ways to get around that. So there's a lot of people that first start to get into the markets, especially beginners. You start to see the PDT rule as a hassle, and especially if you start to get consistent and very, very good at following patterns, following trends, at the same time trading and being consistent on that side. Then you start to see the PDT rule as a hassle where you're not able to really take advantage of the plays that you see come to you. So from there's going to be different ways to get around the PDT rule, but first you have to really understand what the PDT rule is. The PDT rule started in September 28, 2000, and in layman's terms, what it means is if you have less than $25,000 in equity or combined equity, let's say you hold $10,000 in cash and the other $15,000 in other holding positions, outside of that, if you hold less than $25,000 in overall equity, you're only able to day trade 3 times every 5 business days. So automatically you can really see how this will limit your ability to get in and out of positions multiple times every single day and trading, let's say 2 or 3 times per day if you have less than $25,000 in equity. So it becomes really a hassle on top of a lot of beginner traders, and at the same time there's penalties for breaking that. So if you place 4 trades within those 5 business days, that's going to be going over PDT, and the penalties range from just a slap on the wrist. A lot of times that your brokers may send you an email or send you a message to say, hey, you're kind of trading too much, kind of tone it down a little bit. Outside of, sometimes you'll actually get restricted in your account, so you won't be able to place any trades in your account for 30, 60 or 90 days. So I've heard some horror stories of people in a penny stock that, hey, they get hit with PDT and get hit with the restricted account, and they can't jump out of the position until 90 days later. And as we know, most of the penny stocks and small caps, hey, these are horribly fundamentally run companies. So over the long term, these companies are going to fall drastically. So you never want to hold a penny stock for 90 days. This isn't like Apple or Amazon or anything like that. These are very, very crap companies. So really holding into those and getting a restricted account is going to be a nightmare. But first thing you really have to know is really what is a day trade, so you really can kind of understand the dynamics of how the PDT rule works. Day trade is basically buying and selling the same security on the same day. So if I enter stock XYZ early in the morning at 8:30, the market opens for us at 8:30 on Central Time. At 8:30, right when the market opens, I buy XYZ. Let's say the last second that the market is open, I sell it. Within that time period, it's still within the same day, and it counts as PDT. Even if you buy in pre-market and sell in after hours, it's still within the same day, which would be PDT. Now, what gets outside of PDT is, let's say, for example, I buy stock XYZ towards the end of the day and I hold it overnight, and early in the morning, let's say pre-market or once the market opens, I sell the stock. It won't be a day trade. It will be really more of an overnight hold, which is kind of like a swing trade in a sense. So whenever you buy any type of security on one date and sell it the next date, it's automatically not going to be a day trade. So that's a way to get around the day trading rule, but certain stocks don't allow you to do that, because certain stocks that shoot through the roof, then they start to downtrend, and you never want to hold these stocks for a long period of time. I do a lot of momentum trading, so a lot of the momentum side inside the intraday really doesn't carry over into multiple days. Sometimes it does, sometimes it doesn't. So it's really very, very hard to tell a lot of times. So hey, I mean, overnight holds and swing trades are usually going to be more towards the stocks that can kind of hold their price range. Now, one way to get around PDT out of the 3 ways that I'm going over is going to be using a cash account. So a cash only account is going to be an account that's non-marginable. So you're not borrowing any money from the brokerage. If you want to know what margin is borrowed money from the brokerage. So if you're using a non-marginable account, cash only account, it's not going to count towards PDT. PDT is only for margin accounts only. Now, with using a cash account, you're going to have the T+3 rule, which is kind of like PDT, but basically what it means is after you place a trade, let's say you buy into the stock with $1,000 in equity, or just $1,000 in cash. Once you sell the stock, you won't get the proceeds from that trade not until 3 days later. So it has to take 3 days for it to settle into your account. It's almost like a bank account. So if you ever use, let's say like eBay or PayPal, and you want to send money to your account or something like that, it doesn't happen instantly. Usually it takes like 3 days for the money to settle, then it gets transferred into your account. And that's just how it goes. So it almost works as a bank account. And what happens is, especially if you're first starting off into trading and you have a smaller account, let's say you only have $1,000 account, to use a cash account, you're going to have to separate that money in equal portions to kind of partition it for day by day. So let's say, for example, usually with smaller accounts, it doesn't really work as well. Let's say you have a larger size account, let's say around $3,000 or so. If you have $3,000 in your account, and on Monday you trade $1,000 worth of capital, that proceeds from that aren't going to clear until 3 days later. So the next day, you're still going to have $2,000 left. You only trade $1,000 worth of capital. Then the next day, you're only going to have $1,000 left in capital, and you're going to trade that. And by the time the next day happens, that first Monday trade, those proceeds are going to actually clear, and then you start to trade again. And it's called juggling. That's why I usually like to call that term whenever you're using cash accounts and you're just partitioning money and letting it settle as you're going on through the week. It's kind of, you're juggling your account. So a lot of times it takes somewhat of skill to really learn how to do that. And at the same time, it's not really very, very good for smaller accounts, because you have to partition your money in thirds or sometimes in fourths. So just imagine if you're starting with a smaller account around $1,000, you're only going to be able to trade with only $300 or $400, which isn't going to net very, very good gains. I usually like to aim for 8 to 10%. So, hey, $40 here, $30 here, it's not too bad. But hey, you're trying to really grow an account very, very quickly. Now, also, since you're not using margin, you won't have the ability to short sell. So if you're not able to short sell, if you're a short bias trader, which a lot of times I like to short some stocks as well, that's going to really hurt me very, very badly, just because I like to short a lot of plays that kind of blatantly say, hey, short me, like DRYS. So if you're not using a margin account, you're not going to be able to short. Now, number 2 is going to be broker hopping. So broker hopping is kind of a DIY type of deal. Really what it is you're splitting money between multiple brokerages, and you're doubling or tripling the amount of day trades you have available. So let's say, for example, you're using Thinkorswim and E-Trade, you'll have 3 day trades on Thinkorswim, but at the same time, you'll have 3 day trades on E-Trade as well. So if I use 3 day trades on Thinkorswim, I can jump over to E-Trade and use my 3 day trades from them. But the same thing almost has to apply, just like a cash only account, is you're going to have to partition your money either in half or in thirds or whatever. So if you're using 3 different brokerages accounts, you're going to have to split your money between those 3 brokerages accounts. So you won't be able to take as large of positions that you want to. So that's kind of the downside on that side. And especially if you're first starting out, it's going to take a lot of capital to be able to split it evenly between a lot of brokerages and have the ability to pull a nice amount of profit from each trade. So that's one way to do it. I've seen a lot of people do it this way. I've done it this way sometimes. I would trade between Thinkorswim and sometimes Robinhood, just as like doing a lot of swings and stuff, especially if you're not going on PDT. Especially I've seen a lot of other guys do it as well, using Thinkorswim, E-Trade, and Robinhood as well. Between those 3, using all those day trades. See, sometimes you can get up to 9 day trades a week. So especially if you trade over 9 times a week, hey, I mean, that's not that you're over trading, but if you take advantage of every single opportunity and they become very, very good opportunities for you to trade, then hey, I mean, more power to you. But usually when you're first starting off, you're not going to be able to trade that frequently and be as accurate, just because you're just starting off and you're just learning. But that's kind of how that dice rolls. It's kind of for some people. Some people don't like to do that. Hey, I mean, it's up to really your personal preference. Now, the third way that you can do that is going to be offshore brokerages. And a lot of people kind of already know about this, especially with SureTrader. SureTrader is an offshore brokerage. I believe they're based in Jamaica. So they're not under the PDT rule. The PDT rule only applies to US-based brokerages. So the fact is, if I'm trading a Canadian brokerage, a Jamaican brokerage, a Ukrainian brokerage, any brokerage that's not in the US isn't going to be PDT based. So hey, I mean, you have the ability to get around PDT. Now that doesn't mean that you get to get around some form of fees. So usually money transferring to offshore brokerages usually become a hassle and have a lot of fees with them, just because you can't just send money. Normally you have to send them usually over wire transfers, which they usually like to charge a lot for, and there's always a lot of fees hitting, because they know people don't want to deal with PDT. So either you deal with PDT or you come to our brokerage and we just hit you with tons of fees. So I've seen that a lot. That happens especially with SureTrader. A lot of people get to SureTrade and say, hey, this is going to be easy in the breeze, and they start to hit those fees, and hey, oh my god, I mean, what's happening? So it kind of happens a lot of times with brokerages, and that's just how they run until a brokerage comes around that let's say, for example, that is offshore and it has a pricing structure of like think or swim. Then you will kind of be able to get around the PDT rule in a nice fashion. But outside of that, I still haven't really seen as good of options. It's just the best option is just to trade your account and break it past PDT, so you don't have to really deal with it. And also, you have no protection by the SEC. The SEC is here for a reason. I mean, the Securities and Exchange Commission is here to regulate brokerages, to regulate stocks. I mean, a lot of different things that they do, and they don't do things just to kind of hurt traders. They also do things to kind of protect us as well, because I mean, there's a lot of scam artists out there. So you have to really kind of see the both sides of the coin. But outside of these three different ways, that's really the three different ways that I know that's going to be, you're going to have the ability to get around the PDT rule. Now, the number one way, in my opinion, is basically going to be learning stocks, trading patterns, repeating that process every single day, and looking for consistent ways to make profit. I have tons of videos on some strategies, consistency tips, especially how to get across the PDT rule as well. But using that is always going to beat out these stopgap measures of using cash accounts, broker hopping, and offshore brokerages as well. But outside of that, this is Jay from Easily Profit. Hope you guys have an awesome day. Hope you guys break PDT too.